Every major financial disaster, Black Monday, the dot-com bubble, the 2008 crash, had one thing in common, a single chart that predicted them all. It's called the 10-2 bond spread, and it's been Wall Street's worst-kept secret for decades. What's crazy is that most people outside the financial world have no idea it even exists. And right now, it's flashing warning signs that are hard to ignore. In this video, I'll break down the 10-2 bond spread, what it is, how it's predicted every major market crash, and why it's flashing red right now. More importantly, I'll show you what this means for your money and how you can prepare for what's coming. Alright, so what exactly is this 10-2 bond spread that has predicted every crash and signaling the next? Let me break it down in the simplest way possible. Imagine you're lending money to someone. If they want to borrow for a long time, say 10 years, you'd probably charge them a higher interest rate. Why? Because the longer the loan, the greater the risk that something could go wrong. But if they only need the money for a couple of years, the risk is smaller. So you'd charge a lower rate. Makes sense, right? That's basically how the bond market works. Now, the 10-2 bond spread compares the interest rates, or yields, on two types of U.S. Treasury bonds, the 10-year and the 2-year. Normally, the 10-year yield is higher than the 2-year because investors expect to be compensated for locking up their money for a longer time. But, and here's the spooky part, sometimes this flips. The 2-year bond starts paying more than the 10-year. This is what's called an inverted yield curve, and it's a big fat warning sign that something is not quite right in the economy. Why is this a big deal? Because every U.S. recession since the 1970s has been preceded by this exact scenario. Every single one. And it's not just a coincidence. It's actually a reflection of how investors are feeling about the future. When the yield curve inverts, it's like the market is collectively saying, uh-oh, we think a slowdown is coming. Historically, this chart has nailed it. It predicted the dot-com bubble burst, the 2008 financial crisis, and even the brief COVID-19 recession. Think of it as the Nostradamus of finance, but, with actual data behind it. But why does this happen? Well, when investors are nervous about the economy, they flock to long-term bonds because they're considered safer. This increased demand drives up the price of 10-year bonds, which lowers the yield. At the same time, the short-term yields rise because the Federal Reserve is usually hiking interest rates to combat inflation, and that trigger yield curve inversion. So, here's where we're at today. The 10-2 bond spread has been negative for quite a while now, but more on that later. How does this simple chart manage to predict something as massive as a market crash? Let's break it down step by step. First, when the yield curve inverts, meaning the 2-year bond pays more than the 10-year bond, it creates a domino effect that messes up the entire economy. Why? Because it signals trouble for two key players, businesses and banks. Here's what happens to businesses. When short-term interest rates rise, it becomes more expensive for companies to borrow money. Think about it. If you're in a business trying to take out a loan to expand and suddenly the cost of borrowing spikes, what do? You hit the brakes. You stop hiring, cut back on spending, maybe even lay off workers. This creates a ripple effect, slowing the economy even further. Now let's talk about banks. These guys make money by borrowing at short-term rates, like that 2-year term, and lending out long-term rates, like the 10-year. It's called the spread, and it's how banks stay profitable. But when the yield curve inverts, that spread shrinks, or worse, it disappears, making it harder for banks to make money. And when banks aren't lending, businesses and consumers feel the pinch. But that is just the beginning. The real kicker is how this affects investor psychology. When the 10-2 spread goes negative, it's like flashing a big neon sign that says, something bad is coming. Investors start pulling their money out of risky assets like stocks and pouring it into safe havens like bonds. This shift can accelerate the market's downturn, creating a self-fulfilling prophecy. Here's a metaphor for you. Imagine you're in a crowded theater and someone yells, "Fire!" Even if there's no actual fire, people panic and rush to the exits. The chaos itself causes injuries. That's what an inverted yield curve does to the financial markets. It triggers panic before the real trouble even starts. Now, why has this been such a reliable indicator? It all comes down to cycles. Economic booms and busts are natural, and the yield curve essentially acts as a thermometer for these cycles. When short-term rates rise faster than long-term rates, it's a sign that the economy is overheating and a cool down is on the way. So what's the bottom line? The 10-2 bond spread doesn't just predict crashes, it helps cause them by tightening financial conditions and spooking investors. Alright, so we've established that the 10-2 bond spread is a big deal and that an inverted yield curve is like a warning siren for the economy. But what's the story today? Why is the bond market flipping out and what does it mean for us? Right now, the 10-year Treasury yield is hovering around 5%, a level we haven't seen in years. To put that into perspective, the last time bond yields surged like this, it triggered massive market corrections. And here's the kicker, the yield curve has been inverted for months. That means short-term bonds are paying more than long-term bonds, which is like Mother Nature putting thunder clouds on the horizon. It's not a question of if a storm is coming, but when. So, what's causing all of this chaos? There are a few culprits, but let's start with the big one, inflation. Prices are running hot, and the Federal Reserve has been playing with interest rates to cool things down. When the Fed raises rates, short-term bond yields climb higher because they're directly tied to those rates. Meanwhile, long-term bond yields have been slower to rise because investors are still nervous about the future and piling into 10-year bonds for safety. The result? An inverted yield curve. But it doesn't stop there. Government debt is just another factor. Just last week, the U.S. Treasury issued a whopping $119 billion in new debt. That's like maxing out your credit card and then asking for a bigger limit. Investors are starting to worry whether the government can sustain its borrowing spree, which is driving yields even higher. And then there's the global picture. It's not just the U.S. dealing with these issues. Bond yields are rising all over the world, from the UK to Japan, as central banks grapple with inflation, sluggish growth, and political uncertainty. The result is a global bond sell-off, which is putting even more pressure on yields. The stock market hasn't fully reacted to all of this yet. In the past, surging bond yields have gone hand in hand with steep declines in equities. But so far, stocks have been relatively resilient. Some analysts are calling this a calm before the storm moment, and let's be honest, that's not exactly comforting. So where does that leave us? The bond market is sending strong signals that trouble is brewing, but the stock market hasn't caught up yet. This creates a tricky situation for investors. Do you trust the calm surface of the stock market, or do you prepare for the storm that the bond market is predicting? First, let's talk about the risks to the stock market. Historically, when bond yields rise sharply like this, it's bad news for equities. Why? Because higher yields make bonds more attractive compared to stocks. Imagine you're an investor. If you park your money in a safe 10-year Treasury bond and earn 5% with zero risk, why would you bother with volatile stocks? This shift in investor preference puts downward pressure on stock prices. In fact, Goldman Sachs recently warned that if economic data takes a turn for the worse, we could see a significant correction in the markets. And honestly, that doesn't sound very far-fetched. Next, let's look at borrowing costs. Rising yields aren't just bad for Wall Street, they hit Main Street too. Higher bond yields mean higher interest rates on things like mortgages, car loans, and business credit. If you're a homeowner or a small business owner, this could make borrowing more expensive, which in turn slows down spending and growth across the board. It's a vicious cycle. There are ways to protect yourself, and it all starts with taking a hard look at your portfolio. If you're heavily invested in high-risk stocks or speculative assets, now might be a good time to rebalance. Focus on quality, companies with strong fundamentals, consistent cash flow, and minimal debt. Diversify. And I know you've heard this a million times, but it's especially important right now. Spread your investments across different asset classes, stocks, bonds, real estate, even commodities. That way, you're not putting all of your eggs into one basket. And don't forget about international exposure. Markets outside the US might offer opportunities that can offset domestic volatility. Also, cash is not your enemy. In uncertain times like these, there's nothing wrong with holding some cash. It gives you flexibility and allows you to pounce on opportunities when the markets dip. Warren Buffett once said, "Cash is a call option with no expiration date." If it's good enough for Buffett, it's good enough for us. In fact, he himself is sitting on $325 billion in cash because of current market conditions. Now, let's talk about what not to do. First, do not panic sell. Yes, the market may take a hit, but selling everything in a rush could mean locking in losses and missing out on future gains. Remember, markets are cyclical. They go down, but they also come back up. Secondly, avoid trying to time the market. Even professional investors struggle with this, and getting it wrong can be costly. Finally, remember that crashes, while scary, are also opportunities. Some of the best investments are made during downturns when prices are low and the crowd is running for the exits. The key? Long-term thinking. As Warren Buffett says, the stock market transfers money from the impatient to the patient. Don't try to time the market, it rarely works. Some of the greatest fortunes were built during downturns because smart investors saw the dips as opportunities to buy quality stocks at bargain prices. Want to know about the top 5 stocks the smart money is buying during the bubble? Click the video on the screen.